to share with you an amusing story about gold. There is this man that returns home very late one evening and very drunk to find his wife livid and shouting at him and accusing him of having an affair. And in his stupor, he protests and appeals and says, "Darling, I just went to a bar after work to have a drink, and I had a drink too many, and I was distracted because the bar was so lavish. It even had gold urinals in the loos." So his wife, not believing him, calls the bar, asks him which bar it was, and calls the bar, and asks the bartender, "Can you please confirm to me, do you have gold urinals in your loos?" And here's the bar attendant speaking to someone else in the bar and saying, "Hey, Rob, it seems that we found who pissed in your saxophone earlier." So the moral of the story is that not everything that shines is gold. I manage the Junior Gold Fund that invests in junior gold and silver mining companies. And arguably has been the most difficult sector of the market to invest in the last 5 years of bear market. We have been investing in our group in gold mining companies, both private and public, since 2002. So we had a very strong run in the rise of gold from $300 up to 1927 in 2011. But since then, it has been a horrible bear market. The price of gold has been drifting, and all the equities have suffered. We set up the Junior Gold Fund in 2009 in the aftermath of the financial crisis of 2008, because we recognized that gold had retained its value much better than any other class, yet the mining equities had been extremely oversold and unloved by all investors and presented a very compelling investment proposition. So we set up Junior Gold as a sector allocation tool to offer investors the opportunity to invest in the smaller capitalization gold mining shares with a diversified approach without going into the specifics and the difficulties of analyzing a gold mining company and understanding the pits and danger, the pitfalls and dangers. The fund was one of the 2 best performing gold funds since inception in 2009 to the top of the market in 2011. But it has since shrunk for a value of about $100 million in 2011 to about $10 million today. And that shows how investors have fled the sector in mass and deserted the space because they simply did not believe in the ability of gold miners to generate to generate profits as the gold price fell. This is some important risk warnings, as we always have to warn our investors. Investing in gold mining equities is extremely volatile and extremely dangerous, particularly in a bear market. But there is a strong belief that in a bull market cycle, and it has been demonstrated not only by our fund performance but by other market participants, smaller gold mining companies can outperform by significant margin both the market as well as the commodity. So the main question in everybody's mind at the moment is gold still investable? The 5-year bear market still persists. We can see from this chart from Bloomberg that the known ETF holdings of gold are at the lowest since 2009. And it shows that the financial investors are no longer interested in holding gold. Only the brave can reach for gold, which is precariously perched over the $1,000 per ounce level, considered critical for the mining business. And there is this interesting picture of Michael Caine reaching for gold at the final stage of the Italian job film. However, we believe that there are very strong and valid reasons to continue to hold gold. The first and most important in our view is that it provides insurance against the unexpected. We have so many risks emerging in today's world that we believe the markets underestimate. We have the geopolitical risks emanating from the Middle Eastern unrest and all the terrorist atrocities that are being committed in the developed world. We have the potential conflict between the West and Russia over whether it is over Ukraine or their ambitions in the Middle East. Plus, we have some conflict between China and Japan. So geopolitical risks have actually increased dramatically since the financial crisis of 2008. Furthermore, we have the possibility of banking crisis. We have touched it briefly in the Eurozone earlier in the year with a crisis over Greece and its potential exit. I am a Greek national by origin, so I know the situation there very clearly and intimately, and believe that the Eurozone is still not out of the woods. In addition to the Greek financial problems, we have much more significant and substantial economies like France and Italy with their huge debt levels, and that could bring further disruption to the Eurozone. Finally, we have a potentially emerging markets crisis due to the recent collapse of the commodity prices. We see major economies such as Brazil, which are suffering under huge levels of debt, and with a declining earning capacity of their commodity exports, they are finding this debt ever harder to service. We also saw the instability of the Chinese stock market earlier in the year, in August and September, that threatened to destabilize the global equity markets. And if any of these larger economies suffers a banking or financial crisis, the central banks of the developed world will be unable to save it. It's not a matter of pumping liquidity in the markets. It becomes a much bigger global problem. And that is where we believe that, first of all, the global equity markets will be extremely destabilized and potentially correct substantially. The bond markets will be very unstable. And that is when gold should shine as a store of value and as a safe haven. The second and perhaps a reason to a certain extent related to the first one is as a diversification away from traditional financial assets and fiat currencies. During the past 15 years, we have seen that gold has outperformed produced consistently positive performance, particularly in times of instability. In the two more recent major corrections in global equity markets, in the tech bubble bursting in 2000 to 2002, and most recently in the financial crisis 2007 to 2009, gold provided unique protection in all major currencies. And finally, it is widely accepted that the global allocation of portfolios to gold is less than 1% of outstanding financial assets, which means that even a small increase in the allocation of global investors could influence the price of bullion very dramatically. Now, we can explain the aversion of financial investors towards gold with interest rates being at historic lows. It is cheap to borrow, whereas cash in the bank doesn't earn very much. So there is a very big incentive for investors to put their money at work in the global equity markets that appear to be in a fairly good health, on the basis that the central banks will always come back to help them if there is any major crisis or instability. Despite warnings that all may not be well in the global economy, it is easy for investors to follow the momentum and just disregard any safety consideration. And we always have to bear in mind that most things that go up fairly quickly usually correct the hardest when the sentiment changes. This chart is very interesting to us. It is produced by Metals Focus and the World Gold Council, two of the most reputable bodies tracking the gold trade. And it just shows you here that, in fact, physical demand for gold has been fairly robust during the last year. We can see that jewelry demand has risen significantly, but most importantly, bar and coin demand has been very strong, counterbalanced by continued selling from financial investors via the ETFs and some reduction in demand for technology applications, and some a little bit of selling from central banks after a 5-year period where the central banks had been net buyers of gold. There is some speculation that this fall in demand or this selling by the central banks might be related to the Chinese crisis, because when the stock markets are extremely unstable, there are margin calls, and all sorts of financial institutions need to tap to their more stable assets, including gold. So the net change in the year to the end of the third quarter of this year is a healthy 7.6% growth in demand. And there are also strong indications that Chinese demand has been picking up. In particular, the premium of Shanghai Gold Exchange traded gold over the London exchange has risen consistently over the past year, and it currently stands at about $6 per ounce, which is a 2-year high. Perhaps that demonstrates that there might be a little bit of an imbalance of availability of gold bullion in the Far East, which is the region demanding most of the physical bullion. But it also shows that generally the Chinese are buying. And these are people who have this long-held belief that gold is a store of value and believe in its longevity and its ability to keep, to retain their wealth better in times that are dangerous. This chart is probably my favorite chart, which I have picked up from the presentation of Goldcorp. And Goldcorp is one of the largest producers of gold in the world. Last year, in 2014, they produced 2.9 million ounces from their global operations. They have a very large research department, which we believe is very professional and very competent, so there is no reason for us to question their analysis and their data. And what this chart shows, which is very interesting to us, is that it indicates that the peak discovery of gold reserves in the world happened in 1995, 20 years ago. And since then, in spite of the massive bull market from 2000 to 2011, and you can see the green line showing the grassroots exploration spend plus 3/4 of late exploration spend, meaning that it's all the exploration spending money that all of us as investors have plowed in the earlier stage companies looking to find new mines, plus most of the late stage exploration spend which is required to continue the mining operation of mature mines, has failed to produce meaningful discoveries and add to the reserves of the world. The second part of the chart to the right shows how, according to Goldcorp, we have reached peak production this year. And from next year on, we will see very, very dramatic and very sharp drops in production and a shortage in supply. And that is, from a common sense point of view, makes sense, because what the 5-year bear market has done is that it has starved any gold mining company from capital, and exploration spending has contracted dramatically. So any hope of finding new ounces diminishes very rapidly. And it is not unreasonable to think that if for whatever reason, whether it is for some kind of a financial crisis event or some other event that influences financial investors to look back into gold as a safe haven and a store of value, this growth in demand and this reallocation towards gold could be met by a very sharp shortage in supply. And we all know what happens to a commodity when supply is short of demand. If we are to decide, therefore, that gold is still an attractive investment, the question in most people's mind would be, how do I invest? Do I invest in bullion or in shares of gold miners? Well, the price of gold bullion is bound to be more stable over the long term. But as investors, we always have to think of the timing, the stage in the market and the probability of a recovery against further decline. We are at the end, or we are still perhaps at in a 5-year bear market, and the question is how long can this bear market last? And is there likely to be a recovery in the gold price? The shares of the gold miners have been sold off very aggressively and trade at historically low multiples, but there are many pitfalls still. Most miners have placed cost control on top of their strategy, but many still struggle to survive with excessive debt and unprofitable operations. High grading, which is a tactic employed by most mining companies in an effort to reduce costs, in our view, cannibalizes mine life and the longer-term economics of a mine. So when the financing for the exploration and development of earlier stage assets has dried up and constrains growth, it makes the mining company much more difficult to regain its momentum and grow its production and operations. But in terms of possible upside, in crude terms, if we envisage a gold miner that produces at, say, $800 an ounce cost, marginal cost, that company makes approximately $250 per ounce at today's prices. If gold rose by 24% to $1,300 per ounce, the miner's profit would double. And when a company's profitability doubles, it has a corresponding and possibly much more magnified event in its market capitalization and the re-rating of its shares. So in terms of thinking where the market is at the moment and how to position your investments, gold bullion is bound to be much more stable and protect you from protect your capital from further downside. But on the other hand, if you believe that gold might stage a rebound and recover its composure, then gold miners can provide a much more important appreciation and recovery of the lost profits, if you like, or the losses of the last 5 years. There are some very important technical indicators that in our view, point to a recovery in gold shares. For example, if we look at the Philadelphia Gold and Silver Index over the last 35 years, it shows that we may be at the 4th major buying opportunity in that in a period of 35 years for gold mining shares. We have after each change of the cycle, there have been bull markets in excess of 100%. And that is for the index. So by positioning one's portfolio in the better quality companies, one would expect to outperform the index. So after such a dramatic decline, after 5 years of more than 70%, there is a considerable scope for recovery and capital gains from investing in mining shares. Another technical indicator that we like is that gold shares have not been so cheap for over 20 years. And this chart plots the value of gold as a currency against the gold mines index. And you can see that recently it has risen well above 1 times, which is unprecedented over 20 years. And it's a useful indicator as to how cheap the global mining equities are compared to gold. Of course, there are some qualifications in this chart that the gold mining industry has suffered tremendous losses over the last 5 years. It has been forced to write off the legacy asset. It has been forced to take dramatic impairments on its balance sheet. So there might be a little bit of qualification in that chart. I was looking recently at a study conducted by PricewaterhouseCoopers on all the mining sector around the world. And what they looked at was the impairments that the industry took in 2013. The 2014 guide hasn't been produced. In 2013, the top 10 largest mining groups in the world, and that includes the diversified mining groups, took impairments of roughly 10% of their combined market capitalization. By comparison, the listed gold miners in the same period took impairments of more than 25% of the market capitalization in impairments. And that indicates to us that the gold mining industry has been much more radical in rebalancing its business, has been forced to write off the legacy asset, has been forced to restructure its balance sheet and deal with excessive debt. So the theory goes that at present the gold mining sector might be in a much better health than it was 2 or 3 years ago. It has been proven that smaller companies tend to outperform in a bull market. So if one believed that we may be set for a recovery in gold prices and the gold shares, it probably would be better to invest in smaller capitalization shares rather than the very large integrated miners. But due to the stressed market conditions, we believe that very careful filters must be applied in a portfolio selection. And the most important, in our view, are, first of all, the disclosure level by each company. And this is one of the most common failures for smaller companies, that they do not give enough information and enough reports from their public sites, their websites and public information channels, to allow investors to evaluate their prospects. Evaluating a company involves making an investment decision that understands the results, understands the position of the company, understands the balance sheet structure, and how they are positioned in the current market, which is very dangerous in terms of margins. Another important filter is the location of operations. The political and jurisdictional risks can present themselves in many guises. But in our view, today's geopolitics rule out very large parts of the world. As we are so exposed to the volatility of the commodity price and the price of our output, why should we concern ourselves with worries about the title of ownership, the protection of our ownership, or indirect taxation by various countries? So we tend, particularly at this point in the market, we tend to focus in the more stable, the more politically safe jurisdictions that support mining activities. Another filter that we are very conscious of in the present market is high grading that I mentioned earlier. Improving the profitability of a mine, by definition, relies on either reducing your costs, improving the efficiency of your operations, or by increasing the price of your output. As the price of the output is dictated by the commodity price, on which a mining company has no control of, one way is to focus on the higher grade zones, which means processing those areas of your mining plan that contain more ounces, a higher grade of gold per ton, as it costs invariably the same to process a ton of low-grade ore and a ton of high-grade ore. Well, what that does is that it effectively cannibalizes the mine life, and the economic longevity of your project, because you are taking out the richer part of the mine, which has supported perhaps the economic viability of your feasibility study at the outset. So one has to take particular care in understanding whether an investee company is high grading and therefore robbing your long-term net present value from the deposit just to stay alive in the bear market. My fellow panelist earlier, Mr. Hambro, who is an experienced miner, argued that it is possible for a mining company to very efficiently mine the high-grade zones and later on move on and continue mining the lower grade without any damage to the plan. To that, my concern and my qualification is that if you have, for example, 1 million ounces in your deposit, and the 800,000 ounces of those are contained in 20% of your deposit, and you go out and mine that first at marginal profitability, then you don't have very much left to mine over the rest of your mine life when your gold prices have risen. So, of course, it has to do with the metallurgy, it has to do with the type of mining operation and the way the block models and the economics work, but invariably, today's environment indicates that most of the mining companies are high grading. The deposit type is particularly important, specifically to this regard, as some geologic settings and deposit types stand a very poor chance of expanding when the gold price rises. Open pit or underground mining can be equally effective, but always depends on the type of rock and the location of the mine. The next point to be careful about is the market capitalization. What is the price we are paying for the company's assets and the management? A surprising number of companies don't even provide the share structure on their websites. And useful indicators are also market capitalization per ounce of gold of reserves, as well as per ounce of production. Balance sheet considerations. Most companies that have survived the bear market so far have restructured the balance sheet. However, many are still under pressure from the financiers and have agreed to large convertible features that will heavily dilute shareholders even if the gold price rises. This information is necessary to either validate or kill an investment concept. Commitments and liabilities are something that are not obviously seen from the reports of the companies and the balance sheets. For example, there may be excessive land payments, royalties, work commitments, clawback clauses, etc., that can prove disastrous to a company, even if the operations are attractive and your commodity price is rising. Excessive hedging, often demanded by financiers, can limit the upside potential in a rising price environment. And last but not least is the people. The experience of the incumbent management and their length of tenure in this bear market is paramount when you look at an investment. New teams that are coming in to restructure operations might be able to shake up the laborers and the operators and the efficiencies, but sometimes they can also get it wrong. So there is a big risk. I would like to discuss now two examples of companies that we believe offer a sustainable investment proposition in the current environment and who are among the top holdings of our fund. The first one is a Canadian operation called Lakeshore Gold, and is listed on the Toronto Stock Exchange. It's a significant market capitalization company, a mid-cap, I would say, of about 530 million Canadian dollars. But it is an established producer that perhaps has been the most successful in making large improvements in cost control and production efficiency, despite the growth in the production. They have only started operations in 2012 and have grown production by more than double in this period, yet their cash costs have dropped by more than 40% in the 3 years, whereas their all-in sustaining costs more than halved to $872 per ounce in the same period. The company guides for the current year that their all-in sustaining costs will come less than $950 per ounce, but it could well beat that level of 2014, as we can see that they have continued to maintain their control of costs and the pressure on their operators. I should mention, as at the start of this page, that it operates in Ontario, in Canada, which we believe is one of the best mining jurisdictions in the world, with a very stable regime, a very strong rule of law, and a very supportive government for mining operations. In terms of its balance sheet, it has recently fully repaid its senior secured debt. It has cash of about $88 million against a credit line of about 90. So on a net basis, it has no debt. And if one were to think that its production guidance for 2015 is 180,000 ounces, compared to a market capitalization of 530 million, we believe that it is very, very cheap and very attractive. Diversification of production is also important in that they operate 3 multi-million ounce complexes that offer operational flexibility and an ability to increase production should gold prices rise. So contrary to other companies high grading and drawing in their resources in order to survive in the market, This is a company that keeps growing its production, and it keeps offering flexibility and operational leverage to the rise in the gold price. And finally, they have recently made an acquisition which could add another 80,000 ounces per year. It offers, again, it reinforces this potential for organic growth. I would add here that 2 of their mines have doubled their reserves in 2014 from the year before, and their ongoing exploration in the vicinity of operations indicates promising mineralization. The next example I'd like to share with you is a West African operation by the name of Endeavour Mining. I think we have about 5 minutes, yeah? This company operates 4 mines in West Africa, where it aims to produce just under 500,000 ounces in 2015. Arguably, the jurisdictions of Mali, Ghana, Burkina Faso, and Cote d'Ivoire have suffered some political unrest in recent years, but it is very notable that their mining operations have not suffered any material disruptions. So in spite of some political instability in the region, their diversification by country as well as operational diversification has ensured that their mining has continued unabated. They have very high proven and probable attributable reserves that will support growth to 800,000 ounces per year, and their all-in sustaining costs have come down to $950 from $1,137 in 2013. Excuse me. Again, they have been prudently using their free cash flow to pay down debt. Their end of September cash was $32 million, with debt $260 million, and market cap of $250. And the company is led by a seasoned team of mining and finance veterans who I believe are very strong in managing the business in the low gold price environment. So this is another example that offers a very large operational gearing to the gold price, but on the other hand has some jurisdictional risk and some risk due to its debt level that perhaps are a concern, but it seems to be managing very well in the current price environment. So we have to bear in mind that over the last 14 years, gold outperformed the S&P 500 63% of the time by a factor of 249 times to 1. And let's hope that the market will turn around in our favor in a very due course. I'm happy to take any questions you may have. Yes, sir. As I said earlier, I've been long and wrong for far too long to make prediction of the gold price, but it looks like after a 5-year bear market, we may have reached a very strong floor, and it all depends on the macroeconomics, in my view. There are so many things that could go wrong with the global economy and with the geopolitics that could influence the financial investors who are the margin drivers of the gold price to switch back into gold. And then we could have price appreciation very, very rapidly and to possibly higher levels than we have seen before. Yes, sir. Yes, we don't hold Hummingbird resources in our fund or in our investments because it's still at the early stages of developing its major mine and ramping up its production. So I believe that in this level of the market, where we don't know where the gold price is going, and if it dips below $1,000 per ounce, it's going to be extremely dangerous for undercapitalized earlier stage companies that have not reached maturity and full production yet. We believe that it's safer and more prudent to focus on companies such as the ones that I have shown that have this ongoing operational skill to control their activities, even if the gold prices fall substantially. You know, these companies can scale back operations, can cut costs very rapidly, and still stay in business. Other companies that have not started, have not reached maturity are very vulnerable. Okay, thank you very much indeed. Thank you.